Hey guys, this is Shailesh Kumar from Astute Investors Chronicle, and today I'm going to talk about portfolio diversification. Mainly, I'll talk about a few strategies that actually work. Let's get started. Diversification divides investors. It's crazy. Many investors who pick stocks or funds, they run concentrated portfolios, including me. I used to be one of them. I believed in backing my best ideas. Many of the ideas paid out handsomely, and some did not. This was okay. If you have a good strategy and you're disciplined, over time, you will do well. You learn from what works and what doesn't, and you continue to tweak and polish your strategy. Over time, I learned that diversification is not only for the people who do not know what they're doing. True, it does protect against mistakes, but it also protects against unknowns and unknowables. But this is not all. Diversification can actually improve your returns. Listen on to see how. Understanding diversification. Diversification in investing is mainly about hedging risks. If you believe in modern portfolio theory, you know that if you invest in a well diversified portfolio, you will be able to hedge away the company specific risk, and all you will be left behind with is the market risk. Of course, then you can hedge the equity market risk by buying bonds or cash instruments, etc. Are you too exposed to the vagaries of the US economy? Go international. Own too much real estate in hurricane vulnerable Florida? How does Colorado sound? Even if you do not invest in real estate, perhaps you own an insurance company stock that provides home insurance. Wouldn't you want this company to be diversified across geographies so no one particularly bad earthquake or hurricane wipes them out? Managing risk is certainly a big reason why you should diversify. A diversified portfolio is less volatile overall, even if it contains highly volatile assets, provided these assets are not very correlated with each other. When diversification is done well, it can help your portfolio ride out all economic conditions. A 60-40 equities bonds portfolio is designed to be one such portfolio. Another example is the permanent portfolio, which includes other risk diversifiers such as gold. As you will discover, when diversification is coupled with active rebalancing, you get what is called a rebalancing bonus, a pump in your portfolio returns where your overall portfolio returns are greater than the sum of the returns of its individual components. Let's talk about some of the core diversification strategies. There are many ways to diversify, and as an individual investor, you should consider all of these and utilize them in managing your portfolio. At the very least, you should be diversified across different asset classes such as equities, bonds, real estate, and commodities. A typical recommendation is to go heavy on high risk assets such as equities when you're young, and then transition to overweighting income assets such as bonds as you get closer to the retirement. When you're younger, you are in the accumulation phase, and growing your assets quickly is your primary goal. You're also able to recover from setbacks as you have time working for you. When you get older, you move into the distribution phase, where you may want your accumulated investments to start generating income for living and other pursuits. Geographical diversification is important for real estate and other real estate correlated assets. Additionally, if you are mainly investing in your own country assets, such as stocks, international diversification will help mitigate country risk. Within equities, also consider diversifying by industries or sectors. For example, you may be overexposed to a specific industry, perhaps due to your employment. It is also likely that you may have taken an outsized position in a sector you believe in its growth potential. Also, be open minded. If you are a landlord in Silicon Valley, you are exposed to the technology sector even if you do not own any tech stocks. Finally, consider diversifying based on investment styles. I used to focus exclusively on value stocks. And yes, over time, value does better than the market. But you know what is even better than value? Diversifying your value exposure with another uncorrelated factor. We'll talk about factors in just a little bit. Uh, Advanced diversification techniques. We'll talk about three of them. The first is using alternative investments. As you may have sensed, correlations play a big role in diversification strategies. If you own Nvidia stock, for example, and then you buy AMD stock, are you diversified? Maybe a little. At least some of the risks that are specific to Nvidia are hedged. However, these two stocks are very highly correlated, and if it is the diversification that you're after, you'll be better off buying a consumer discretionary stock instead of AMD, such as Colgate or Procter& and Gamble. But what if you buy something totally different? Suppose you have an opportunity to invest in a new restaurant in your city. I would argue that this gives you a much higher diversification possibilities. Investing in private equity, hedge funds, and cryptocurrencies can be great diversifiers as well. Factor based diversification. We briefly mentioned factors. Factors are attributes of investments that have been shown to provide persistent outperformance historically. For example, value stocks do better than the market over time. This is a well known anomaly in the efficient market hypothesis. Benjamin Graham is the best known exponent of this. Another factor that performs better than the market is investing in small company stocks. Other factors include momentum and quality. Some factors, such as value and momentum, also tend to be countercyclical. When value does well, momentum is probably not doing that well, and vice versa. Therefore, buying these two factors can be a great way to diversify your portfolio. Temporal diversification, also known as time based diversification. If you have a long investment horizon, the investments that may be highly volatile on a daily or a monthly basis are not as volatile on a yearly basis. This is the reason why investing in stocks is considered risky in the short run, but pretty much a sure investment if you're looking ahead for decades. Using this insight, you can diversify your assets based on your investment horizon. Want to buy a house in 10 years? You should blend in equities and fixed income. If you're saving an emergency fund or for paying taxes in few months, you better be in cash or very short term investments. Life cycle funds are based on this principle. Dollar cost averaging strategy works very well for long term investments. It takes full advantage of temporal diversification and helps in smoothing out short term volatility. How do you implement diversification in your portfolio? Many portfolio management tools offer you a way of checking correlations between different holdings in your portfolio. For example, I use StockRover, and it can show you correlations within the portfolio. If your assets are highly correlated, you need to diversify. If you're buying ETFs or mutual funds, tools such as Morningstar can categorize your funds in a 3 by 3 matrix based on size, small, mid, or large, and style, value, blend, or growth. This is a good look. They also have an X ray tool to check for overlaps in investments underlying two funds. Typically, you would want to diversify between different asset classes like stocks, bonds, REITs, and commodities. Factors like value, momentum, and size and geography like US, international, and emerging markets. Your particular allocations to these factors will depend on your risk preference. Once you allocate, you'll find that allocations drift over time. Rebalance your portfolio frequently, at least once a year, but don't rebalance too frequently. You do want to give each asset time to perform and generate enough returns for you. Do not interrupt compounding unnecessarily. In both our portfolios on this Substack, free or paid, I use these diversification principles and rebalancing techniques to minimize volatility and maximize returns. Common mistakes in diversification: over diversification. Too much diversification can dilute potential returns. What is too much diversification? A portfolio is sufficiently diversified with 5 to 10 lightly correlated assets. No need to buy a total market index fund and an S&P 500 index fund at the same time. Mistake number 2, neglecting correlations. Do not neglect asset correlations. With a highly correlated portfolio, you do not receive any benefit of diversification or rebalancing, and your risk is just amplified as you have a big portion of your net worth exposed to some of the common risks. Mistake number 3, ignoring new opportunities. I'll just take an example. Cryptocurrencies are great diversifiers. Many investors still shun them, not believing in the investment merit of these assets. That doesn't mean you can't use them to diversify your other assets. Diversification and rebalancing is as close you can get to free lunch in investing. Make them integral parts of your investment strategy, and you'll find that profitable investing is no longer complicated. Thank you, and subscribe to get other episodes and new articles as I write them. Thank you very much. Take care. Bye.